Good afternoon. This is Chris Robinson, Robinson Ag Marketing with today's post-close grain livestock comments. Well, a couple key points here. Right now, um, the announcement is supposed to come out Wednesday or Thursday. Rumors or speculation has it that's going to be a 3-year quote-unquote commitment. They're trying to get the Chinese back to their typical purchases of 15 to 20 million metric tons coming out of the U.S. The problem is having a memorandum of understanding is not a contract or anything. They get if they come out and say, "Yeah, we're going to do this for the next 3 years," it's kind of like an NFL football contract. It's always renegotiable later on, and it's really unless it's a signed contract, it's just going to be interesting to see how the market comes up. I'll just leave it at that. Right now, South American soybeans and meal are cheaper than the United States. So again, if that uh, continues, it is a free market. And the Chinese, well, they may say, okay, well, look at the U.S. It's like, if you've got one car costs $3,000, the other one costs 2,300. Which one are you going to buy? So it's all coming together here. It's very, very interesting that this is all it took to spark this rally in beans. This rally in beans today, beans finished up 11 cents. At one point, they had been up more than that, another 20 cents really. The high in Novi beans was 1091 and a half. The low of 1065 and a quarter. So nearly a 30-cent range today. We settled at 78 and a quarter. If you're following my letter, if you're following my recommendations, we wanted to get after it and use this 1-year high. The high all year had been 1079 and three quarters, 1075 and three quarters back in February. And so we're just right there. We did take out 1091. We hit 1091 and a half. In my opinion, it's a gift to producers because the math is still out there where the beans and meal from South America is cheaper than our beans and meal. But like people always say, any port in a storm. This has been a gift rally. We waited for this all year. Remember this, we started the beginning of the month at 994. So I'm just gonna call it from 994 to 1091, nearly a dollar rally just in the last 3 weeks here. So we waited all year, and we'll see. This is a rally I think we're going to want to use. November 2026, above $11. Also a 1-year high, settled at 1103. That is something to watch because what's the market telling you? The old high from September of 2024 for that contract had been 1106 and three quarters. We went right there today. We hit 1107 and a half. I know people hate to start marketing 2026 when we're still dealing with 2025, but it's things you've got to look out there. It might be something where you want to look at, especially because let's face it, a month and a half ago, certainly back in April, we were down at 990 to be at 1103, and Christmas of 2024, we were at 983. It's all about revenue. It's not about what they're saying on CNN or the New York Times or anything else. In fact, it was kind of ironic. As soon as those people started squawking about, had woke up to the fact that soybeans were, in a depressed state, you just got to wonder who got short down there and just had their face ripped off on a dollar rally. So, and for whatever reason, however you want to cut it, this was a marketing opportunity for producers. And I'm not saying it can't go higher, but good Lord, don't let a dollar rally get away from you, especially when, now we've done the entire trading range, basically in the last month. So take advantage of it, take advantage of it, take advantage of it. Nobody sells the absolute high. What I want guys to be doing is getting the meat of the move. People that try and get the absolute high, I always tell guys, make the sale. And you can tell people at the coffee shop, whatever you want to talk about it. At the end of the day, you don't want to miss a dollar rally trying to get the last 3 cents. That's absurd. And so be an adult, bite the bullet, do some risk management, make some sales. And again, if you were crying in your coffee a month ago, and if you don't do something about this rally, I think you're making a mistake. These corn, why oh why did we stop at 436 and a quarter? First of all, thank goodness we finally finished the task of filling in that gap from the July 4th weekend, 432 and three quarters. Guess where we settled? 432. So we've magically turned back the clock to the first week of July. We also, for whatever reason, and again, if you're not getting my letter, you might want to get it. You can learn a lot about technical analysis. These levels do matter. If you take the yearly high at 479 and three quarters, and you take the yearly low at 392, the high today is 436 and a quarter level, halfway back, 50% retracement. So bull or bear, you're equally wrong at this point, equally right at this point. It brings us back to the middle of the range of the entire year. We've had an 87-cent trading range. Again, I know that sounds crazy. And we've looked at this time and time again. Markets like to do 50% retracements. The next level up I have above that would be a 62%, and that's about another 10, 11 cents away. Who knows if we can get there or not? I don't know. I do have a cash sale recommendation out there for my clients. The other level we're looking at, coincidentally, would be the 200-day moving average, which was right at 430. Let's see where it ended today. The 200-day. The 200-day in the corn ended the day at 37 and a quarter. So throw it all in a big ball of wax. 36 is the 50% retracement. 37 and a quarter is a 200-day moving average. That's going to be big resistance, kids. So use it as you will. I did have some clients that we had calls on from earlier in the year. Those picked up value today. We were able to take some money off the table on those, at least where it was possible. And so again, just because the markets rallied up here to halfway back, I sure do hope that we go higher. I'd love to get back to 470, the spring insurance price. I would love to do that. We'll see what happens though here in the next 2 or 3 weeks. Again, there's a lot riding on the Wednesday, Thursday meeting when they come out of that room. Not that China buys any corn from us. They really don't. This is all about soybeans. Okay, moving over to the wheat. December wheat finished up 3 cents. Again, kind of a sympathy rally, not kind of, a definite sympathy rally, a sympathy spike. Manage money. What's going on there? Money flow. The funds are short about 100,000 corn. They're probably still short about 90,000, 85,000 corn. However, they gradually, over the last 2 or 3 weeks, went from being short beans to flat beans to long about 15,000 beans. Now, I bet you they're long around 40 or 50,000. So, again, if you hate the speculators, maybe you should reassess that because they're a big part of the reason we just rallied $1 this month. Okay, and we're right up against the 2-day moving average. You can thank all the people you love to hate when they're bet short against the farmer. They really don't have an agenda. Their only agenda is chasing money. They're like a great white shark. Their only job is to swim through the ocean and eat. The managed funds job is to take $1 and turn it into $10. So they're the wind at your back now. Take advantage of it. Don't assume it's going to continue. And we all know that it could turn very quickly. So whatever your risk is, I don't care. Use this rally to readjust it. Kansas City wheat finished up 5 3/4 cent at 520, traded as high as 525. Again, are people going to step in there and say the lows are in? I don't know. No, last week on October 14th, we were at 5-year lows, 477. So, a 30, 40 cent rally. It's a good start, but we have got a lot more to do. You got to remember, back in June, we were at 575. We went from 575 to basically 475. So we had that dollar break. This is all relative. So use the rally as best you can. Don't fall over yourself trying to call the bottom and call the tops. Just use the rally to manage your risk. All right, moving over to the cattle. Very, very technical today. I'm in the process of doing the breakdown there as well. But boy, we waited for a long, long time, in cattle to have a correction like this. Fat cattle actually bounced a little bit off its lows. If you go to the deferred months, April bounced probably the most. If you look at the April fat cat contract, the deferred contract, very, very interesting out there. If you take the life of contract move from last November, which was down around a buck 80, believe it or not, and then you take the contract high up around 251, we are right at the 38% retracement. And can we go lower? Yeah, there's support below. But these are the things I cover in my letter. It's very, very technical. I'll just leave it at that. Moving over to the feeder cattle. Boy, it looked like we were going to rally off the start here in feeder cattle. Again, a lot of those markets didn't finish quite lock limit down. They did bounce off limit, but we have had um, absolutely positively a big correction in feeder cattle. 7, 8 days ago, we were at 378 in March feeders. We went from 378 to today's low at 317 half. Okay. That, again, very, very technical. And this is why, if you're not paying attention to technicals, I get it. Maybe you don't understand it. Maybe you don't want to do the homework. I do the homework. Very, very interesting thing about March feeder cattle. If you take the life of contract move from the low of April 2025, 268, to the contract high, 378, lo and behold, today we are what? Halfway back at this 323 level. So very interesting. A halfway back move after the big rally in cattle for this March feeders, and in corn, a halfway back rally from the 87-cent sell-off that we've had all year in corn. So this is why you need to pay attention to this stuff. It doesn't always work. There's always that quote out there, the bottom of the ocean's littered with the ships of captains who had charts. I've been listening to it for 30 years. But these levels, these simple, simple levels, they can do one thing that people hate to do, which is make a decision. They give you an area to look forward towards possibly making the decision. And if you're a producer, you're not just your typical run-of-the-mill speculator. You're basically a speculator that's locked into always being long. So it gives you a kind of a slanted view on everything. You're always looking at things from a bullish standpoint. You want to take advantage of that as best as you can. So we try and use these levels, not because they're perfect, but because they attract a lot of attention. And therefore, they let us make real-time decisions about what we want to do as far as managing our price risk. Finishing up with the lean hogs. Again, very, very technical. I feel like a broken record. You take the contract low in April when we had the first spook from the tariffs. We were down, under 70 cents there. Then we rallied up to 92 cents here. I'm looking, at the February contract. Today's low, nearly a 50% retracement. So I'm looking at a 50% retracement in the corn slide. I'm looking at a 50% retracement in the deferred feeder cattle slide. I'm looking at a 50% retracement in the last rally that we had in the hogs. So these are key levels. You want to make sure that you're paying attention to them. If you're not getting my letter, if you want to learn about it, sign up, take a look. If you like it, stay with me. If you're looking for somebody that brings 30 years of experience to helping you make decisions, give me a call. We'll have a conversation. 312-638-8868. Look forward to hearing from you. Have a great night. It's going to be a wild rest of the week. We've got to get through Wednesday, Thursday, Friday. We've got the meeting on Wednesday. I don't know if they're going to make the announcement Wednesday or Thursday, but there is, at least we have something worth talking about now, that we've got a decent rally in soybeans and corn. Have a great night.